Greetings, Jonathan Camarda, your humble CIO. So today what we're going to do is put 2024 in context as well as look at what we're looking for 2025. So for 2024, the Magnificent Seven, I'm not going to name the names, you all know them. What effect did they have on the S&P 500? And what does that mean? Well, for 2024, if you look at the S&P 500 cap weighted, which certainly overweights those Mag 7 stocks, you had over about 21% rate of return for an equal weight S&P 500, which didn't give the cap weight any undue influence, only about 11%. For your 60-40 strategies, pretty drastic as well. For the S&P 500 cap weighted, which gave again weight to those Mag 7s, about 8 and change percent versus 2 and change percent for 60-40s with an equal weighted S&P as your stock index. So there's a lot of stocks that didn't do well last year, to take the rose color tinted glasses off there. And so when we look at the Santa Claus rally, in fact, the pile on to that, I guess we were all pretty naughty because there was no rally. It was about a 0.5% drop. What does that mean going in to 2025? Well, first of all, Santa Claus rally, again, whimper, right? And when we did our last video, it was before the Fed got up and basically was a little bit more hawkish, right? Jerry got up there and said instead of about 4 decreases next year, probably looking at only 2. And so when you look at inflation, it has been pretty persistent, right? So when we look at Trueflation, great site, takes out the antiquated measures they use, gives you really, just distills a real good view of where inflation is, about 2.81%. Now that's down from the 3s from earlier in the year, but certainly higher than mid-September when the Fed got a little dovish, right? And it was only about 1.7%. So we've seen a hike since then. What does that mean? Well, for interest rates, right, the 10-year, looking at that 4.6% range, 2 years only about 4.287%, about 31.5 point basis point spread. But more importantly, when we look over the last 12 months, the 10-year, the 20, the 30-year, even the 5-year is decently higher than it was a year ago. Only the 2-year is lower. So what does that mean? Again, your longer duration bonds have certainly taken a hit. Now you'll notice an active capital preservation, more conservative strategies. Again, we'll start to sculpt our location on the yield curve, certainly preferring as we have on the shorter duration as far as being overweight. The 1 to 3 year treasury, the only winner in fixed income over the last few months, go figure, right? And that makes sense with where you're looking at rates. As far as currency, King Dollar obviously doing its bench presses as it's been basically killing the euro, been killing the yen, the yuan, the CAD, the AUD, all of them. And of course, right, when rates are going higher, the currency goes higher of that country. Now, also in confluence, we see continued dollar strength going forward because when you look at most of the global banks, they are all cutting and pretty voraciously, whereas we are, again, showing a little bit more restraint there, right? We're not pulling as much there to the dovish side. So the dollar, relatively speaking, should continue to muscle up versus foreign currencies. Now, eventually that creates a little bit of a headwind. Eventually, it has. If you look at the last 3 months, there's four sectors that have been positive, the usual suspects, right? Do you need me to name them? Okay, I will. Discretionaries, your consumer, your communications rather, your financials, right, have been doing well, and your technologies. Everything else negative. Now, believe it or not, healthcare got out of last place, right? The old market NFL there. Materials was actually worse the last 3 months as it surpassed healthcare to hit the bottom. I guess it's going to get the first draft pick. So from that standpoint, again, only 4 sectors that have been strong. Now, as far as factor-wise, as we say in Wonkland, large cap growth, momentum, go figure, right, have been the strongest. And small cap growth snuck in there, but small cap's got its issues, right? Because if we're looking at a little higher rates long term, small cap companies borrow more, so that's a little bit of a headwind there. Now, when we start to look at, essentially what that means going forward, pretty interesting. Earnings expectations for 2025 are pretty high, but it would factor in about a 19% growth in earnings, which is a pretty good strain. It takes a lot of weight as far as to pull that up, and those earnings expectations have to be met for continued bullishness. So that is a little bit of a tug of war there, and that could be a little difficult, especially if inflation's more persistent. The Fed can't be as dovish. and we start to see some turmoil there. Now, credit spreads, the spread between your treasuries and typically your double B, just above junk corporates, are still pretty tight, pretty narrow, which means, again, more risk on, perhaps some complacency. So again, as we move into January, as Santa Claus failed to pass that baton on, and we had to pick it up out of the red dirt for you runners out there, Santa Claus didn't hand it off to us. For January, the January effect, right, of how markets go, pretty powerful. If we have a green January, usually portends pretty well for the year, and if not, could be a turning point with Santa Claus again dropping the bag of gifts off the roof there at the end. No offense, St. Nick, but that's kind of what happened. So as we move forward, what does that mean, right? So January will have that type of influence, which we will be watching carefully. Next time we see each other, we will review what we've seen, for the month at that point. So going forward, that's what we're looking at. Now, in our tactical strategies, we're a little bit more, again, nimble. You'll notice in some strategies, some moving of the chairs. Again, we do want to assess the plane in which we are playing on from that standpoint. As we did have a little rally here, a little one this past Friday at the end of the Santa Claus rally period, still about 0.5% short of positive. Sorry, Santa. But that little rally technically put the S&P 500 just a little bit above the 50-day moving average for your technicians out there. Very important moving average. The Dow Jones has been underwater so long. It's doing, what were those hurricane players doing, right? Zombieland. It's been in Zombieland. Now, the Dow Jones is a little bit more antiquated, right? A little bit than it was 20 years ago, but still, we are watching that system come across, as the meteorologists say. The NASDAQ, believe it or not, and that makes sense with technologies and communications and all that doing well, has been firmly perched above that 50-day, the most attractive of all of them at this stage. So as we look again across the spectrum, we do have to be nimble and see where the market takes us. Now, if you're wondering as far as bull markets and the length of those horns, we'll finish with this. Historically, the average is 67 months. This bull market started in October of 2022. That's about 25 months for this bull market. So you would say it's about a third there. Now, the microwaved bull market from 2020 to 22 was only 21 months. So we're getting a little long in the horn. We'll see. I'm not picking Texas, just saying. Certainly not. And then as far as in the tech bubble, that bull market ended in the early 2000s at 60 months from the 90s. And the financial crisis was actually 131 months of that bull market that led up to 08, really from like 03 there. And so as you start to look at it, 60 and 131, the last two bull markets, pretty long horns, right? Again, no Texas reference. So no letters from you Ohio State fans. But however, this one we're only at 25 months. So what does that mean? Well, we could have a long way to go, or this could be a new, again, post-COVID situation where, again, economic cycles are more condensed, and we may have to pull out an umbrella there. That was kind of a little mime there. So with that being said, as I've called, spoken to, and left messages for clients, certainly to get feedback on your risk appetite and how it applies to the models, which are mostly tactical. Again, your PWAs, clients out there as well, will be discussing as well your allocation and what that means, income changes, all of those financial planning situations that are imperative, that are, again, packed into the overall plan, regardless of what the market's doing. Those discussions are important. So with that being said, it's a little crisp out there, so it won't be too hard, hopefully, for you to do your job. Stay frosty. We'll stay eternally vigilant as, we'll see. Does the bull market make the playoffs? Like Joe Burrow, will he be playing next week or sitting on his couch? Who knows if the market will be that way as well. We'll know next time we speak. We'll have a clearer picture there from that standpoint. So, again, I'm working today. That's on mute. Hopefully you ladies and gentlemen enjoyed your football live with some sound. And until next time, always a pleasure to serve. And aloha means we'll see you soon.